Say something that's going to make a lot of traders uncomfortable. If you're trading alone, you're not just slowing your progress, you're actively destroying your discipline, and eventually your account. Not because you're stupid, not because you're lazy, and not because you don't want it bad enough, but because trading alone is the fastest way to lie to yourself. Trading alone does not give self-discipline by itself. And if you've ever blown a prop firm account, or broken your rules, or watched a funded account slowly bleed out after you knew what you were supposed to do, this video is going to explain exactly why that keeps happening and how consistently paid traders avoid it. It's not your strategy. Most traders think discipline is about willpower. They think discipline is waking up early. They think discipline is being patient. They think discipline is forcing themselves not to overtrade. That's all wrong. Discipline is not a personality trait. It's not a motivation. And it's definitely not something you can white-knuckle your way into. Discipline is a system. And if your system is me, alone, staring at charts, making decisions in my own head, that system is bound to break. Here's the paradox of prop firm trading. Prop firms give you rules, but they don't give you structure. They give you max drawdown, they give you daily loss limits, they give you profit targets, but they leave out the most important piece: how a human being actually follows rules under pressure. Rules do not give you structure. You need much, much more than rules to give you a structure that you cannot break. Because here's what actually happens. You pass the challenge, you get funded, you tell yourself, okay, now I'm going to be disciplined. And for a while, you might be. But then you take one trade outside your plan, you justify it because the setup was clean, you size up slightly because you're close to a payout, you hold one loser too long, you revenge trade to get back to even, and suddenly you're breaking your rules you swore you'd never break. Not all at once, but one rationalization at a time. Here's the truth no one tells you. Human beings are terrible self-regulators in isolation. That's not a trading problem. That's a psychology problem. When you're alone, your brain does three dangerous things. It rewrites the rules in real time. You don't say, I'm breaking my plan. You say, this is basically the same setup. It's close enough. It doesn't count. I'm already in drawdown. I'll be disciplined tomorrow. It's not that much. Rationalization will kill your account. It confuses emotion with intuition. Fear feels like caution. Greed feels like confidence. Overtrading feels like being engaged. And because there's no external feedback, you believe the voice in your head is logic. It's not. It's emotion wearing a suit. It's a wolf in sheep's clothing. It removes consequences. When no one sees your trades, when no one reviews your execution, when no one asks why you broke a rule, there's no immediate cost. And behavior without consequence always decays. When you're in isolation, who do you have to be accountable to? No one? This is where most traders get it wrong. They say, I just need more discipline. No, you need less reliance on discipline. You need a strategy that can't fail even with you behind the wheel. Every consistently paid trader understands this. Willpower is unreliable. Systems are not. Think about it. We don't rely on willpower to brush your teeth, stop at red lights, show up to work on time. Those behaviors are enforced by structure. But trading, you're asking your nervous system to risk money, make decisions under uncertainty, control emotion, follow abstract rules, all while alone. That's insane. No structure can lead to emotional trading. Here's the biggest difference between traders who get payouts and traders who keep blowing accounts. Paid traders don't trust them. That sounds harsh, but it's actually freeing. They don't say, I'm disciplined. They say, I operate inside constraints. They build predefined execution rules, external review, fixed routines, non-negotiable risk frameworks, and most importantly, they don't trade in a vacuum. They have other traders, mentors, review processes, feedback loops, not to copy trades, but to prevent self-deception. The internet romanticizes the solo trader, the lone wolf, the guy grinding in silence. I don't need anyone mindset. That identity sounds strong, but it's fragile. Because when things go wrong, there's no one to catch you. In prop firm trading, small mistakes can compound fast. One bad week can erase months of progress. One bad day can erase days of progress. One emotional day can violate a rule that you can't undo. Here's something I learned the hard way. The traders who get consistent payouts are not smarter. They don't have secret indicators. They don't have superhuman discipline. They simply stopped trading alone. They put themselves in environments where bad behavior is visible, good behavior is reinforced, mistakes are caught early, and once that happens, discipline stops being a struggle. It becomes automatic. If you've ever said to yourself, I don't know why I trade that way. I don't know why I took that trade. I knew better. I broke my rules for no reason. What was I thinking? There was a reason. You just weren't aware of it. And until you understand this part, you'll keep repeating the same cycle, even with a good strategy. The problem isn't knowledge. Let me walk you through the exact loop that causes traders to blow funded accounts. It's not theory. This is pattern recognition. Step 1. You follow your rules. At first, you're locked in, you're disciplined, you're patient, you're proud of yourself, your P&L stabilizes, confidence builds. Step 2. You get emotionally invested in the outcome. Now the trade means something. You're close to a payout. You're trying to recover a small drawdown. You want to prove consistency. This is where emotion can sneak in. Quietly. Emotion enters when outcomes matter. Step 3, you bend a rule just this once. You don't smash the rules, you nudge them. Slightly earlier entry, slightly bigger size, slightly wider stop. I think it's going to go that direction. You tell yourself, I'm still basically following the plan overall. This is the most dangerous moment when you start to rationalize. The result reinforces bad behavior. Here's the trap. Sometimes that rule breaking works. You made money on the trade, and now your brain learns the wrong lesson. The market rewarded a bad behavior. Not skill, not discipline, but deviation. Step 5, the behavior escalates. Now the door is open. The next deviation feels easier. The next one feels justified. The next one feels normal. And eventually, you violate a hard prop firm rule, daily loss, max drawdown, account gone. This is where people get defensive. They say, but I journal my trades. Good, but journaling alone doesn't stop this loop. Why? Because you're both the criminal and the judge. You can always explain away your behavior after the fact. You write things like market conditions were weird, high impact news, low liquidity, I was slightly off mentally. Those might be true, but they are also to protect your ego. Self-review protects identity. Your brain's number one job is not profitability, it's identity preservation. And when you trade alone, your identity never gets challenged. Here's another lie traders believe. If I just watch the charts more, I'll get better. For beginners, screen time helps. For funded traders, most of them, more screen time equals more opportunities to make emotional decisions. Every candle becomes a temptation. Every micro move feels like a signal. Overexposure can lead to overtrading. This is why many traders start strong, then slowly decay, then implode. They don't lose skill, they lose restraint. And restraint cannot survive consistent stimulation without structure. Let me ask you something important. Who sees your bad trades? Who questions your sizing? Who asks, why did you take that setup? If the answer is just me, that's the problem. In every other performance-based domain, athletes have coaches, pilots have checklists, surgeons have peer review, businesses have reporting. But traders think they should operate flawlessly alone? With real money? Under stress? That's not discipline. That's gambling with extra steps. No feedback can lead to drifting. Consistently paid traders do something unintuitive. They limit their freedom. They reduce their number of trades, number of sessions, number of instruments, number of decisions. Why? Because fewer decisions require fewer emotional resources. They don't say, I can trade whenever. They say, I trade only under these conditions, and those conditions are often externally enforced. Here's what happens when traders stop operating in isolation. Mistakes get caught earlier, bad habits don't get a chance to grow more, rules stop being optional, and sometimes powerful things happen. Discipline stops feeling like effort. It becomes the path of least resistance. Not because you changed who you are, but because you change the environment you operate in. If you're honest with yourself, you don't need another strategy. You don't need another indicator. You don't need more motivation. You need structure that doesn't let you lie to yourself. And in the next part of this video, I'm going to show you the exact structure consistent payout traders use, how they design their day to eliminate emotional decision making, and how mentorship actually works without copying trades. This is where trading finally becomes boring, and boring is profitable. At this point, most traders realize something uncomfortable. It's not that they can't be disciplined, it's that the way they're trading makes discipline impossible. So now the question becomes, what does a trader who gets consistent prop firm payouts actually do differently? Let's break it down. Discipline is designed. Most traders imagine consistency looks like this: same strategy, same rules, same risk. And while those do matter, it's not what separates paid traders from blown accounts. The difference is how their day is structured. Not how smart they are, not how many setups they know, but how few decisions they're allowed to make. Fewer decisions can lead to fewer mistakes. It can come from fewer emotional resources. Let me show you what consistent payout traders actually do on a daily basis. This is not exciting, but it works. They fix trading windows. They do not overtrade whenever the market looks good. They trade one session, one window, one predefined block of time. Why? Because time boundaries prevent emotional chasing. Time limits prevent revenge trading. When the window closes, they're done. No exceptions. Predefined trade limits. They don't aim to make money. They aim to execute a maximum number of quality trades, usually 1 to 3 trades a day, sometimes 0. This removes outcome obsession, and when outcomes don't dominate the mind, rules get followed more easily. Loss-based shutdown rules. This is huge. Paid traders don't wait until max drawdown is hit. They shut down early. Not because they're scared, but because they respect statistics. One bad emotional trade can snowball into 5, so they stop before emotion takes over. Here's where things really separate. Blown account traders review results. Paid traders review behavior. Let that sink in. Behavior is more important than P&L. They ask questions like, do I follow every entry criteria? Did I size correctly? Did I respect time limits? Did I stop when rules said to stop? Notice something? None of these require the trade to be profitable. This shifts the brain from did I win to did I execute correctly? And that shift is everything. Now here's the brutal truth. Most traders know the structure, but they don't follow it. Why? Because enforcing structure on yourself is almost impossible long term. You'll skip reviews when they're uncomfortable. You'll loosen rules when no one's watching. You'll rationalize exceptions when P&L is on the line. That's not weakness. That's human nature, which is why structure must be enforced. When structure is external, everything changes. Deadlines get respected. Rules stop being optional. Emotions get checked early. This is why traders in funded groups last longer. Traders with mentors blow fewer accounts. Traders with reviews get paid more consistently. Not because they're better traders, but because bad behavior doesn't survive visibility, it gets upheld by accountability. Let me clear something up. Real mentorship is not signal copying, hand-holding, being told when to enter or exit. Good mentorship does one thing exceptionally well. It removes your ability to lie to yourself. That's it. You still trade your plan. You still make your decisions. You still own your results. But now your rules are visible. Your execution is reviewed. Your habits are tracked. And the moment you drift, it gets corrected before it costs you an account. This is why consistent traders sound boring. They don't chase. They don't panic. They don't force trades because they don't need to. Their process catches problems early. And boring is how you get paid. Here's something most traders don't expect. The most dangerous moment in your trading journey is not when you're losing, it's when you start winning. Success can bring on a new risk. Let's talk about what happens after your first payout. You finally get paid, you feel relief, you feel validated, and quietly something shifts. You stop thinking I need to protect this account and start thinking I've figured it out. That confidence feels earned, but it's also dangerous. Because now discipline doesn't feel as urgent. These are common post-payout behaviors. They take slightly more trades, slightly bigger size, slightly looser rules, slightly more opinion. Nothing dramatic, just enough to change the risk profile. Small changes can give big consequences though. This is why one of the most common patterns in prop firm trading is first account, cautious, structured, patient. Second account, confident, aggressive, flexible. The trader didn't lose skill. They lost respect for variance. And they forgot that the market didn't change, their edge didn't expand, risk still compounds, but confidence tells a different story. And when you're trading alone, no one checks that story. Here's the distinction that saves accounts. Confidence feels good. Consistency feels boring. Confidence says, I can handle more. Consistency says, I don't need more. Paid traders choose consistency, not because they're scared, but because they understand probabilities. They know one good month means nothing. One payout proves nothing. One streak doesn't change expectancy. One sample does not give you your edge. Now let's talk about something uncomfortable. Many traders don't just blow accounts accidentally. They sabotage them subconsciously. Why? Because consistency creates pressure. Pressure to repeat results, maintain identity, not to mess up. That pressure creates anxiety. Anxiety can look like overtrading, micromanaging, second-guessing, forcing setups. Ironically, the closer you get to making it, the harder it becomes to stay disciplined. Pressure can create errors. This is where mentorship becomes essential, not at the beginning, but at the moment when confidence starts outpacing structure. Mentorship does three critical things here, at least. It normalizes variance. You don't panic over a red week. You don't celebrate a green one. Everything is contextualized. 2, it slows down when you want to speed up. This is huge. The moment a trader wants to size up, add frequency, expand strategy, a mentor would ask, based on what data? That question alone can save an account. It protects you from identity-based trading. When your identity becomes, I'm a profitable trader, every loss feels more personal. Mentorship separates performance from self-worth, and that separation keeps execution clean. Here's the harsh truth. Success built in isolation is fragile sometimes, because the same isolation that lets you rationalize losses also lets you rationalize overconfidence. No feedback, no breaks, no guardrails. Eventually, that account will give you feedback. And it's expensive. If you've ever thought, I was doing so well, I don't know what happened, this is what happened. You outgrew your structure without upgrading your environment. And the market punished that mismatch. In the final part of this video, I'm going to show you exactly what to stop doing immediately, the minimum structure required to protect payouts, and how to use mentorship without becoming dependent on it. This is where everything comes together, and if you apply this last part correctly, blowing account stops being part of your story. At this point in the video, you probably realized something important. Your problem was never a lack of knowledge. It was the environment you were trading in. Environment can shape behavior. It can influence behavior. Let's start with what needs to stop. Not gradually, not eventually, but immediately. Stop treating discipline like a personality trait. Discipline is not who you are. It's the result of constraints. If your trading requires you to be strong every day, that system will eventually fail. Nobody can maintain that forever. Stop reviewing trades only when it feels comfortable. If you only review green days, clean executions, good behavior, you're reinforcing ego, not skill. Growth happens in discomfort. You gotta stop equating screen time with progress. Watching charts is not the same as improving. Execution quality beats exposure every time. Less watching, better trading. Now let's talk about the minimum structure required to stay funded. Not perfect structure, enough structure to stop account bleed. Non-negotiable number 1 fixed trading windows. One session, one window, no exceptions. You gotta stick to it. This alone eliminates half of emotional trades because you're not tired and your resources haven't been drawn out. Non-negotiable number 2, trade caps. You're not allowed unlimited attempts. Trade caps force selectivity. Selectivity protects discipline. Non-negotiable number 3, behavior-based reviews. Your review process must ask, did I follow my rules? Did I respect limits? Did I stop when I was supposed to? P&L should always be secondary. It's a byproduct. Non-negotiable number 4, external visibility. Someone other than you must see your execution. This is where most traders resist, and it's exactly why they stay stuck. Visibility can change behavior. Mentorship only works when you use it the right way. So here's what it's not for. It's not for signals, it's not for entries, it's not for being told what to trade. That will create dependency. We don't want dependency. Here's what it's for. Execution accountability. Your plan is reviewed, your rules are enforced, your habits are tracked. Early error correction. Mistakes are caught when they're small, before they become expensive. Emotional regulation through structure. You don't need motivation, you need containment. Mentorship will provide that. Here's the shift every paid trader eventually makes. They stop asking, how do I make more money? And they start asking, how do I protect my ability to trade? That question will change everything. Because when your account is protected, payouts become inevitable. If you've blown accounts, it wasn't because you're incapable. It was because you're trying to perform. It was because you're trying to perform in an environment that punished human behavior. Once you stop fighting your psychology and start designing around it, trading is much, much calmer, clearer, boring, and boring pays. If this video hit home, and you're tired of repeating the same cycle, passing challenges, getting close to payouts, then watching discipline slowly slip away, this is exactly why I work with traders in a mentorship environment. Not to tell you what to trade, but to build the structure that makes blowing accounts unnecessary, almost impossible. If you want to trade inside an environment where discipline is enforced, not hoped for, you'll find the details below. The market doesn't reward intelligence, it rewards consistency. And consistency is not a solo sport. If you stop trading alone, everything changes. Structure over willpower is what we want. Consistency over confidence, and environment over ego. If you want to see how to exactly set up a prop firm trading strategy, not so it has a great win rate, but so that it's protected against even our most vulnerable psychological traits, click below. I'll show you exactly how to do it. This is where you can start getting consistent payouts every time.